All right, let's talk about one of the most maddening things in trading, the market open. You know what I'm talking about? Especially if you trade gold or Bitcoin. Those huge, wild price swings right when London or New York opens up, it feels like they're just designed to hit your stop loss. Well, today we're going to pull back the curtain and show you why those moves are anything but random.
I mean, seriously, does this hit close to home? You see the perfect setup. A textbook breakout is forming. You jump in, feeling good about it, and then bam! Literally seconds later, you're stopped out. And the worst part? You then have to watch in agony as the price whips right back around and takes off in the exact direction you predicted. That feeling, let me tell you, it's not bad luck. It's a feature of the market, not a bug.
See, to really get what's happening, you have to understand that as a retail trader, you and the big institutions, you're not even playing the same sport. While we're all busy reacting to the price we see on our screens, they're the ones behind the scenes actually creating that price action.
What we're really talking about here is a very specific type of market manipulation. It's all about them trying to artificially mess with supply and demand. They create this false picture of where the market is going, and they have one simple goal: to trick other traders into making a move that puts money in their pocket.
So, why do they do this? It all comes down to one crucial word: liquidity. It's called a liquidity grab, or to be more blunt, a stop hunt. Just put yourself in their shoes for a second. If a giant fund wants to buy $1 billion worth of Bitcoin, they can't just slam a market order. The price would explode upwards and they'd get a horrible fill. So what do? They need to find sellers, and they know exactly where a ton of sell orders are waiting, right below the obvious support levels where everyone places their stop losses. So they engineer a quick, violent push down, triggering that massive cluster of stops. Every one of those stops becomes a forced sell order, creating this huge pool of sellers that the institution can then quietly buy from at a fantastic price.
And this is the perfect analogy for it. We see a level break and we react. That's checkers. They see where our stops are and they plan 3 moves ahead to use our reactions to fill their orders. They aren't just trading the market. They're literally trading against us.
But here's the beautiful thing. Because this is a pattern, because they do it over and over again, it becomes predictable. And if it's predictable, we can build a playbook to spot it, sidestep the trap, and even turn it into an amazing trade for ourselves. It's all about learning to see their footprints in the chart.
So, we're going to break this down into 5 really clear, simple steps. First, we'll mark out the battlefield. Then, we'll look for clues that a trap is being set. After that, we wait for them to spring the trap. Then we look for our signal. And finally, we plan our own trade to ride the real move.
Okay, let's get into it. Step 1 is super easy. The second that first 15-minute candle closes after a major open, like New York or London, you just draw 2 lines on your chart. One at the high of that candle, one at the low. That's it. This little box is our initial battleground. This is where the institutions are laying the groundwork for their trap.
Now here's the million-dollar question. A big candle at the open happens all the time. So how do we tell the difference between a real, genuine move and one of these engineered traps designed to fool everyone? We need to look for confirmation.
So how do we find that confirmation? Well, there are 2 huge clues to look for. First, the size of the candle. Go to your daily chart and add an indicator called the average true range, or ATR. That tells you, on average, how much the price moves in an entire day. Now, if your little 15-minute opening candle is more than a quarter, more than 25% of the entire average daily range, that's a massive red flag. That's not normal. Second thing, look at the volume. A manipulation candle will almost always have a gigantic volume spike with it, way above its recent average. You can track this with a 20-period moving average on your volume bars. When you see that giant size plus that massive volume, that's the footprint of a big institution.
Okay, so once we've spotted a candle that ticks both those boxes, our job becomes incredibly simple, but also incredibly hard. We wait. We do nothing. We sit on our hands until the price actually pushes outside of that 15-minute range we drew. This is the sweep. This is the stop hunt happening in real time. Our only job now is to watch like a hawk for the very first sign of rejection, the signal that the big boys have filled their bags and are ready to send the price flying back in the other direction.
So how do you tell the difference? Well, a fake out, or a liquidity grab, is going to look like this. Price breaks out, and then almost immediately snaps right back inside the range. And after that initial volume spike, the volume just dies. A real, genuine breakout is different. It'll break out and stay out. It'll often come back and retest that breakout level, turning it into a new floor or ceiling, and it'll have sustained, healthy follow-up volume. And these right here, these are the specific signals we're waiting for. We need to see one of these powerful reversal candles form after the sweep, right outside our range. A big bearish engulfing candle shows a sudden, shocking takeover by the sellers. A hammer candle with that long lower wick tells you a story. Sellers tried to push it down, but a huge force of buyers stepped in and said nope, and slammed it right back up. This is our final confirmation. The trap is sprung and the real move is about to start.
So once you see that reversal, candle print, and close, you've got a full trade plan right in front of you. You can enter the trade, but your risk management has to be on point. Your stop loss? It goes just a little bit beyond the wick of that sweep. That level is now protected. If the price goes back there, you were wrong. Get out. And your target? A great first target is the other side of that 15-minute range we drew way back in step 1. This setup gives you an incredible risk-to-reward ratio, which is how you actually make money long-term.
Okay, so now you have the entire technical roadmap. But I've got to be honest, the best strategy in the world is completely useless if you don't have the right mindset. This is where most traders lose the battle, not in the chart analysis, but in their own head.
And this brings us to what is, without a doubt, the hardest part. You have to actively fight your own instincts. That first big explosive move at the open is designed to trigger your FOMO, your fear of missing out. You have to resist that urge to chase. From now on, your default setting needs to be skepticism. Assume every big move at the open is a trap until proven otherwise. Your job isn't to be the first person into a trade. Your job is to be on the right side. So you wait. You wait for the sweep. You wait for the confirmation. Patience is your superpower here. When you finally put all of this together, the technical setup and the mental discipline, it's like a switch flips in your brain. Your entire perspective on the market open just changes. You stop being the prey, you stop being the liquidity, and you start seeing these moves as the setup itself. And this quote just says it all, doesn't it? That moment of absolute maximum pain for the crowd, the exact point where everyone who chased the breakout gets stopped out, that is precisely when the best opportunity begins for you. So, the big takeaway here is this. These stop hunts are not just random noise. They are clear, readable footprints that the biggest players leave all over the market. Once you learn to read them, you can go from being the fuel for their moves to being the surfer who calmly waits to ride their powerful wave.
And I'll leave you with this question to think about in your own trading. In your experience, which session open is the bigger culprit for these kinds of fakeouts? Is it the start of the London session, or is it that wild, chaotic New York open? Let me know what you've seen. Drop your experiences in the comments below.